Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Let me begin. I'm uncomfortable trying to be a Monday morning quarterback, looking back at what was a very challenging time for your banks. And yet, as part of the due diligence that we're responsible for providing and the look back and the oversight, we're looking not just at what would have appeared to be a failure by management, but by the boards as well, and also a look at the regulators and how they responded. And so, Mr. Becker, for you, according to the Federal Reserve's supervisory report released on April 28th, Silicon Valley Bank failed to assess and manage its interest rate risk in its rapidly growing securities portfolio. SVB had breached its long-term interest rate risk limits on and off since 2017 because of the structural mismatch between long-duration securities and short-duration deposits. Over the same period, SVB also removed interest rate hedges that would have protected against rising interest rates. Essentially, when rising interest rates threatened profits and reduced the value of its securities, the management at SVB took steps to maintain the short-term profits rather than effectively manage the underlying balance sheet risks. Now, I had never heard of the term of it being considered a banking 101 discussion with regard to managing the interest rate risks, and yet both community banks, regional banks, and even the larger banks that I've spoken to that have been involved in South Dakota activities all had the same point of view, that this was a banking 101 issue. Could you just share with us the decision to stop hedging interest rate risk? That tool had been utilized by the bank, and yet you decided to stop it at a time in which it really probably could have assisted you in weathering the storm.
Senator, as I outlined in my written testimony, the specific decisions around hedges and investments were done by our ALCO committee and executed by our Treasury team. I don't have access to my documents when I was terminated on March 12th. I haven't been given access to that information, so I don't have access to that. But to answer it as best I can, when I think of the interest rate risk management, there's kind of two parts to it. One is the liquidity risk and then interest rates overall. And as the Federal Reserve said in their findings, we had findings from November of 21. And part of the story that, again, was told is that we didn't respond to them. And again, to my recollection, the feedback that I had directly from our internal audit, the feedback I heard directly from our chief financial officer is that most of those, not all, but most of those were resolved by the middle of 22. So the feedback...
May I just
sure.
But in May of 2022, the Federal Reserve issued 3 governance MRIAs, matters requiring immediate attention, which required a remediation plan by August 31st of 2022, and that may be what you're speaking of. Did SVB actually submit the remediation plan that was required by the regulators? Did you actually submit that to the regulators by the stated due date?
Yes, we did, Senator.
Did the examiners then at the Federal Reserve view your proposed corrective actions as satisfactory? And if not, what feedback did you receive?
Senator, to the best of my memory, we submitted our response, as you do when you have a requirement to be responsive to the regulators. And my recollection is we were still waiting on the specific feedback from the regulators.
Were you expecting there to be an enforcement action at that point?
My recollection is actually at the January board meeting, and just shortly thereafter, the feedback from the regulators is that we were expecting an enforcement action, a memorandum of understanding, which we acted on immediately. That's all the way back in January.
The reason why I ask is because in November of 2022, the Federal Reserve issued an MRA, matter requiring attention for SVB's interest rate risk. The supervisory findings stated that the firm's interest rate risk simulations were unreliable and gave a false sense of safety in a rising rate environment and masked the need to take actions earlier in the rate cycle. Examiners requiring corrective action by June 30th of 2023. I'm just curious, the fact that they had identified the deficiencies, they gave you an MRIA and then an MRA, but they didn't expect you to respond until 2023. Did that somehow suggest that they were relaxing their concerns? Is that the way that the bank saw this when they received this additional follow-up from the regulators?
Senator, I can't speak on behalf of the Federal Reserve on what they were, thinking when they gave that.
No, I'm asking
June
what
timeframe.
you thought when you received it.
Yeah, I can say what my experience was and what I believe the team did. So in my experience, when we get any regulatory findings, we were very responsive. And I believe the GAO report highlighted that feedback from the regulators that they believe we were responsive. And that was certainly my experience, that we were responsive to, whether it was an MRA or MRIA, we treated them the same and moved quickly to remediate them as fast as we possibly could.
I think the 30-some odd outstanding at the time would probably suggest differently. Thank you, Mr. Chairman.